Hello everyone, my name is Kamal Manocha. I represent PMS AIF World in the rhythm of weekly webinars that we do on every Friday. This Friday we have another educative webinar, and this is a unique and a special webinar because this pertains to global markets. We have had, I would say, multiple talks with various thought leaders and fund managers about Indian markets. India being in golden decade, but India is one of the economies. There are various other larger economies apart from India which are fine destinations for investments, and this particular webinar pertains to global investing. And for that we have Mihir with us today, who brings with him 10 years of experience. He's a CFA as well as MB from IIM Ahmedabad. He has been working, as an AVP with Phillip Ventures IFSC, and is an expert in the space of global investing. Global investing offers not just diversification in terms of currency, but various other reasons for one to enhance one's return in the overall context of one's portfolio. In the current dynamics of world economy, there are a lot of drivers which needs to be understood, which make, apart from India, a lot of other, I would say, global offerings a great sense to be added in one's portfolio. So this webinar is for those investors who want to create a well-diversified portfolio mix, not just focused on India, but in the overall context. So we'll do a presentation for first 30 to 45 minutes, and then followed by that, we'll do Q&A. Over to you, Mihir, for this webinar.
Sure. So I hope my presentation is visible, Kamal.
Yes, absolutely.
Yeah. So thank you so much, everyone, for joining us for this rather unique webinar, where I have been given an opportunity to present a perspective on global investments and also speak some bit about the work that we do on the global investing front. So I represent Phillip Ventures IFSC Private Limited. We are a part of the Phillip Capital Group. So, as you may or may not know, that Phillip Capital has a presence in 16 countries, and we are a full range of financial services, servicing clients across the globe. Our India business also is a very strong business, and we are servicing clients across equities, fixed income, derivatives, fixed bonds, and all those other asset products as well. We have a very, very established India PMS division also, and a very, very logical extension to this was to set up the Global Investments Desk, which we have set up in Gift City. So to touch some bit on Phillip Ventures IFSC, we are domiciled in Gift City, and as all of you must be knowing, that Gift City is India's first integrated smart city. It is India's first offshore jurisdiction directed only to facilitate global investments, and we are one of the first players to actually set up presence there. The idea behind us setting up a presence there was to offer a range of offshore products with an outbound focus. Currently, as we speak, we are already servicing clients across different countries, and I will touch upon it in a while. So this is about Phillip Ventures IFSC in a nutshell. We began the discussion by asking one very simple question, that why should we actually explore global allocations in the first place? I mean, Kamal did start the presentation that India indeed is a very long-term strategic story, a very, very structural kind of an advantage India possesses. And truly, this is a decade that actually belongs to India in terms of the economic growth. Then given this backdrop, why is it that we should consider global allocations? Why should we explore other regions? Because today, everyone talks about global markets. Everyone is talking about aspects like the Russia-Ukraine crisis, or let's say the US Federal Reserve, inflation, conflict between maybe China and Taiwan, so on and so forth. So there is definitely a lot of curiosity about global markets. A lot of people definitely show interest. But if we really begin this discussion with some statistics, so let's say we would have invested in these benchmarks. Okay, I have taken the base value of 100 for all these country-focused benchmarks, and this is a 15-year period that we are presenting. So if someone would have started with a value of 100 on 31st March 2008, then over a 15-year period, what would have happened is that one would have seen that the Nasdaq would have actually delivered the highest returns in the respective currency. So Nifty definitely is one of the best performing index, but over a longer period of time, what we do realize is that Nifty has not been the best performing index. Again, Nasdaq is a technology heavy portfolio, and the last decade, particularly in the second half, did focus on a lot of technology based revolution. So comparison between Nifty 50 and S&P 500, if we have to do a direct comparison between India and the US markets, we should be comparing Nifty 50 and the S&P 500. So just a separate or different way of presenting these two data sets, what one would have found is that if one would have started with, let's say, 100 on 31st of March 2008, then over a 15-year period, Nifty 50 would have definitely outperformed the S&P 500. Then in which case, why is it that a global fund manager is actually making a case for investing in the US markets? So the reason is that if you as an Indian investor would have invested in a portfolio of the S&P 500, which is in the US, the returns that you would have made would not only be returns on the S&P 500, but also returns on the US dollar. Because in the last 15 years, what has actually happened is the value of dollar relative to the Indian rupee itself has doubled. So that the total returns which an Indian rupee invested in S&P 500 would be a combination of the S&P 500 returns as well as the returns on the US dollar. So the combined effect of these two forces on your portfolio would be something like this. So if two investors would have started with 100 rupees each on 31st March 2008, then over a period of 15 years, the portfolio, the Indian rupee invested in a dollar portfolio of S&P 500 would have definitely outperformed in the Nifty 50. And this is numbers speaking for themselves. This is just a shorter data. If you really look at the previous decade, okay, now we again explore some bit more as to why one should consider global allocation. So over a longer period of time, yes, Nifty has been the second best performing index, as we can see in this chart as well. But if you really look at the calendar year performance, what we find is that there are opportunities arising in other regions as well. Okay, in some years, Nifty has been the best performing index. In some other years, it has been the worst performing index. So there are pockets of opportunities emerging from other regions as well. But if one has to really closely observe these values, particularly post 2015, what we find is that the major chunk of the returns have actually come from the US markets, particularly Nasdaq, which brings us to the last point. But today, when we are sitting in 2023, and when we are really looking at the entire decade ahead of us, what we realize is that there is a lot of disruption, innovation that is driving businesses across the globe. There are different regions which are at the forefront of developments. And if we were to have the same webinar in 2033, which is 10 years from now, what we would have found is that businesses, industries across the globe would have undergone a severe disruption. And at the same time, the entire investment landscape itself would have undergone a very drastic change. And that is the opportunity that we are talking about today. That today, global investing is not only about mitigating a single country exposure risk, but it is also about capturing some of the trends of today and the ideas of tomorrow, as we've presented over here. Because there are some technologies and there are some innovations where the developed nations continue to take the lead and they continue to drive the next leg of growth for the global markets. So we are actually talking about investing in those pockets of opportunities which otherwise may or may not be available for investment in India. I mean, yes, structurally, India will continue to remain the faster growing economies, particularly in the pack of emerging markets, and definitely a faster growing economy as compared to some of the developed economies like the US. But what we also should realize, particularly if we look at this last slide, is that a faster growing GDP does not necessarily translate into better performing markets. The dynamics have very clearly changed. And that is exactly the idea. That is exactly the opportunity that we are talking about investing in tomorrow. So as I mentioned, that investment landscape itself is evolving, and now is a very good opportunity to align ourselves with this evolving landscape and to invest in the right kind of products and the right kind of strategies in an attempt to actually capture the upside coming from the next leg of growth. Last point, obviously, is to build USD assets because over a longer period of time, the currency of choice for the entire world is the US dollar, and that is precisely the reason why having a portfolio comprised of US dollar denominated instruments definitely makes sense because it is a stable currency after all. Which brings us to the next topic on exchange traded funds. Now, the products that we have that we are offering. So, I will be talking about the global PMS or the global portfolio management services as well as the global advisory. Now, both these products that we are offering or all the strategies under these products, what we are doing is that we are investing in ETFs or exchange traded funds. Now, one might wonder that if the fund manager is investing only in ETFs, then why would anyone come to a fund manager in the first place? Because in the context of Indian markets, everyone understands ETFs as a Sensex ETF, a Nifty ETF, maybe a Bank Nifty ETF. Then why is it that people would actually come to the fund manager who will be investing only in ETFs? So our reasoning was as follows. Now today, if we look at the universe of ETFs in the developed markets and particularly the United States, what we find is that the entire ETF, the entire universe of ETFs is extremely layered. What we find is that today ETFs are available not only on broader market exposures or sector exposures, but there are specific businesses and specific themes that you can invest in. Now, I did talk about investing in some of these innovations of tomorrow in one of the previous slides, but we are talking about products which are giving you direct exposure to concepts like semiconductors, artificial intelligence, robotics, solar energy, nuclear energy, climate change, uranium, lithium, electric vehicles, so on and so forth. In fact, here at Phillip Ventures IFSC, we have developed a proprietary list in-house of all the specific themes that are currently available, which can be invested through using ETFs. So that at any given point in time, we are actually monitoring the progress across 60 different themes that can be invested in using only ETFs. And this is in addition to, or this is over and above the sector-focused funds or the broader market funds. Next is there are different kinds of instruments that you can invest in using ETFs. I mean, ETFs are not only giving you exposure to equities, but there are fixed income, there is currency ETFs, commodities, real estate, REITs for that matter, or even some of these emerging asset classes like special purpose acquisition companies, carbon credits, even cryptocurrencies. You actually have exchange traded funds which can give you exposure to Bitcoin. Again, there are 10 plus sectors. And last point is more than 60 plus different regions. I mean, if we really look at this map in front of you, what you can find is that there are certain countries that we have shaded in blue. Now, these are the countries that you can actually take exposure to using only US listed ETFs. I mean, who said investing in the global markets was only about investing in a US or a China? There are more than 50 to 60 different countries and regions in which you can take exposure to using only US listed ETFs. And that is precisely the utility of the product. To take an exposure to, let's say, Taiwan, you don't have to look for securities in Taiwan. You can directly buy the Taiwan focused ETFs, which is dollar denominated and listed in the US markets. Which brings me to the next question again, that ETFs are fairly simple products to understand. We can still invest in ETFs on our own. Why do we still need a fund manager? So the answer to this question is these statistics to the right. Today, the market for ETFs is a $10 trillion market. Okay, across the globe, more than 10 trillion US dollars of assets are managed. And there are more than 10,000 different listed products which are available on more than 45 exchanges across the globe. There is a lot of choice. In fact, if I have to just share another statistic, in the years 2020, 2021, and 2022, only in the United States, there were more than 400 new ETF launches, which means for every trading session, on an average, you have more than one ETF which is getting offered to investors. And these products are available across a host of themes, regions, and strategies. Okay, there are these video games ETF, for example. There are these Bitcoin ETFs. There are a lot of these derivative based strategies, there are managed future strategies, VIX ETFs, so on and so forth. So many a times what happens is that investors are indeed spoiled for choice and they really don't know where to begin. So the outcome is that either the investor will start dipping their feet everywhere, invest everywhere, only to realize that the overall asset allocation is extremely suboptimal. Or the second option is that they will not invest at all. They will not take a decision and perhaps miss out on the upside. So that is where our expertise comes into the picture. Because we have a global presence, we really have that kind of support from across the globe, where through our process, the entire journey of 10,000 plus ETFs to the final 10-20 ETFs is made very, very seamless to the investors. So now I take the opportunity to present our Phillip International Solutions. So this is a combination of both our PMS as well as advisory. So, I'll just talk some bit of it. So the pillars of our process, why is it that we are able to manage a global product with, so much happening around us? First is that because ours is a product comprised of ETFs, it is much more macro in nature, much more top down of a product. And hence, we are following an out and out data driven approach. Our team works with a lot of data sets across both financial as well as non financial data. And the idea is to really mine a lot of this data with an attempt to find out some key insights and spot some trends which are emerging across different themes, different regions, so on and so forth. Next is focus on fundamentals. Now, this is a very important point because I've been talking about a lot of data-driven approach. There is a lot of intense amount of coding that we do at our end. There are a lot of key insights that we derive from our data, but still at the same time, we assure you that this is not a black box approach. The final decision making is not something which a machine is giving us, but it is thoroughly discussed, debated internally. Because only through these discussions we are able to identify opportunities across different businesses, across different asset classes and regions. I also take the opportunity to tell you that as a global fund manager operating in the Phillip Capital ecosystem, I have an opportunity to interact with my peers, with like similar fund managers as well as wealth advisors and research analysts in other regions where Phillip Capital is functional, like Singapore, Hong Kong, Turkey, Australia, UK, so on and so forth. Third point is a long-term outlook. And this is something that we really strongly believe in, that we are really helping investors achieve their investment objectives. And in this process, what we really focus on is a very, very long-term horizon. We do not advise or we do not construct portfolios which are frequently trading or frequently churning because we really don't want to achieve suboptimal returns. We really take our own time to invest over a longer period of time. Some of these themes, some of these futuristic ideas are very, very high conviction with an outlook of at least a good 5 to 7 years. And that is precisely how we go about investing our investor money. Last point, and perhaps the most important one, is a seamless implementation. So today at Phillip Ventures IFSC, we've really been able to set up processes that align with the evolving Gift City ecosystem. So Gift City is a new ecosystem. It is a new jurisdiction completely distinct from SEBI and RBI. So in this process, we have really been able to demonstrate a seamless experience for our clients, be it in terms of the account onboarding, be it in terms of investors remitting money, either through LRS or directly by NRI investors, and most importantly, actually trading into the global markets. The entire process has been very, very seamless for our investors. So we have two primary products on the asset side, global portfolios and global advisory. So the global portfolios is a portfolio management service, which is a high value product. The minimum ticket size is $150,000 US. And under this, we have three strategies: the Phillip International Pioneer Portfolio, Universal Portfolio, and Bespoke Portfolio. So Pioneer Portfolio is a portfolio which we are currently running. This is the fund where we are actually managing investor money. This is a portfolio which is investing in equity ETFs. In fact, I will explain this in the next slide. The Universal Portfolio is a multi-asset portfolio which we've started offering. And in this portfolio, we are investing in equity ETFs, fixed income ETFs, as well as ETFs of other currencies, commodities, and other asset classes as well. So pioneer and universal portfolios are discretionary PMSs, but at the same time, we have also introduced a non-discretionary strategy, a bespoke solution, also rightly called as the Phillip International Bespoke Portfolio. Now, this is a completely client-driven portfolio where we provide a client with all the infrastructure to set up their accounts, trade in the global markets, receive those reports. We also support the clients in terms of all the insights about the global markets. But there are some of our clients who are very, very confident about the process, and rightfully so, because they come from those kind of industries. So we have given the options to curate their own portfolios and in this process customize their own investment journey with us. The next product or the next offering which we are soon starting is the Global Advisory. Now, this is an advisory product which has been started with the idea of providing smaller ticket size product. This is a solution which actually can serve as a very good entry point for our investors to explore the global market. So that is the entire idea about the Global Advisory. So now I would like to explain some bit on the Phillip International Pioneer portfolio. The very reason why I have a separate slide for this one is because this is a portfolio under which we are actually managing investor money. This is a portfolio comprised of equity ETFs, and the idea is to achieve capital appreciation through exposure to various sectors, themes, and geographies, which we believe will grow over the medium to long term. The philosophy of our fund is that we are enabling our investors to invest in the trends of today and the ideas of tomorrow. Now, this is a portfolio comprised of equity ETFs, but we also have the flexibility to allocate some portion of the portfolio to some of these newer asset classes, like a carbon credit or a cryptocurrency. Are we really investing in these asset classes today? The answer is no. But as and when the industry is really evolving, and when we have a very good reason to believe that these asset classes indeed are moving from a speculative nature to a utility nature, you may actually find this portfolio as part of these ETFs as part of our portfolio also. So just to summarize the process, what we are offering is dollar-denominated portfolio solutions where we are investing in US listed securities. So this is a point which I would like to reiterate, that while through our strategies, you can invest in more than 50 to 60 different regions. But all these ETFs are listed in the US markets. The entire idea and the benefit of that is that our investor sits on instruments which are denominated in the US dollar. And rightfully so, because since the start of our fund itself, in the last 15 months that we've been running the Pioneer portfolio, the US dollar has increased, or the US dollar has gained more than 10% relative to the Indian rupee. And that is the benefit of dollar diversification which we have been able to achieve, or rather the currency has been able to achieve. Next is that we, through our products, we are actually enabling our investors to participate in growth stories across innovations and regional developments. And as I mentioned to you, that we are running these products with a very, very long-term focus. The idea is to not just participate in the global markets, but actually enable our investors to achieve their investment objectives. Some bit on Gift City. So Gift City, as I mentioned to you, is a jurisdiction which is completely independent and segregated from SEBI and RBI. It has its own regulator, which is the International Financial Services Centers Authority. So all the products that we are running, these are offshore products, be the global PMS or the global advisory, but they are very, very heavily regulated by the IFSC regulations. So investors can be rest assured that this is a product which is actually getting regulated by an Indian regulator. And that is the assurance that we would like to convey. And next part is the liberalized remittance scheme. So because Gift City is a jurisdiction which is set up as an offshore jurisdiction, any investment which is remitted to Gift City by a resident Indian individual comes under the liberalized remittance scheme. So that is a point which we would like to highlight. And in our process of maybe the global advisory or the global PMS, we are ensuring that the entire process of LRS is very, very seamless to our investors. And that is the key highlight of the seamless implementation that we spoke about. So now I also take the opportunity to introduce our alternative investments team with all of you. So to reintroduce myself, I am Mihir Shirgaonkar. I come with more than 8 years of experience in the asset management industry. I head the alternative investments function for the firm. Previously, I was a part of the ETFs and passive investments division at DSP Mutual Fund. I am a chartered accountant, a CFA charter holder, and an MBA from IIM Ahmedabad. And in addition to this engagement, I am also a full time volunteer as part of the Public Awareness Committee with the CFA Society India. Now, in this engagement, I am actually contributing to the CFA Society India by way of articles and blogs. In fact, the last two newsletters of CFA Society India have my cover stories, have my articles featured as cover stories. Now, I work very closely with an associate, Rishwik. His background is that he has done his MBA in International Business Management from INSEAD Business School in France. And he's been with the firm for over a year now. The advantage of having Rishwek around is number one, he is an equally data driven person. So that is a very, very logical addition to our team. And second is that for a brief period, he has actually worked in the European markets. So some of these emerging trends, okay, particularly on sustainability, climate change, he has actually observed them firsthand. So he really has that kind of a mindset of really running a global product, and that is how he is on board. So I now come to the last part of our presentation, wherein I share an outlook on the global markets. So we are in 2023 April, and what is it that we really expect? The global investment team expects going forward, and perhaps till the end of 2023. So one factor that will really have to be watched out very, very acutely is inflation and the monetary policy. Now, thankfully, we have quite a lot of evidence that the U.S. Federal Reserve could be nearing its monetary tightening. We can expect one rate cut of additional 25 basis points, given the current information, of course. But inflation, while it has been moderating, like from the CPI value of 9% that was reached last year to the recent one of 5%, 5% continues to remain a high inflation for a developed market. And to that extent, we expect the US Federal Reserve to be hawkish in its commentary. That is something which may affect markets in the short run. Second is the difference between a slowdown and a recession. So again, there has been a lot of talk about a recession happening in the second half of this year. But what we really want to highlight is that there is a difference between a slowdown and a recession. Currently, where we are looking at is that we can definitely expect a slowdown, wherein the GDP will grow at a slower rate, something which is already happening. Because the Q3 GDP last year was 3.2% and Q4 GDP was 2.7% growth. So definitely the GDP growth declined. And slowdown is an objective that has been identified by the US Federal Reserve in order to curb inflation. So whether or not there will be a recession, the next quarter results, Q2 results is something that we believe will be very critical indicators for that. Third trend which is emerging across the global markets is that there is a manufacturing PMI, which is Purchasing Managers Index, and there is a services PMI. Now, for quite a lot of nations like China, Japan, even Australia, actually the services sector is outpacing manufacturing. So to that extent, it is definitely contributing to some growth in the economy. But the risk is that if manufacture doesn't pick up, it may not contribute substantially to global growth. So that is a factor that we are very closely watching out for. In fact, the IMF has actually come out with its GDP forecasts as well, with China expected to have some 5.7% GDP growth. But in China, services are expected to outpace manufacturing. So that is something that we really need to see. China continues to be a wait and watch kind of a scenario, and China is something that we are very, very closely monitoring because ultimately China is known as the consumer of the world. It is a single most nation which can actually drive consumption across the board. So that is something that we are monitoring. And of course, geopolitical dynamics. So we all know that the Russia-Ukraine conflict is an ongoing conflict between the two nations. And at the same time, we are not really calling it a geopolitical war, but a dynamic because there are a lot of policy measures which have been instituted by different nations. Now, United States also came up with its own policy measures to promote its own chip building industry, but that is at a detriment to a lot of Chinese chip makers. So, how these events are really contributing and how these events are playing out on these respective industries, like a semiconductor or an electric vehicles, is something that we will be closely watching for the later part of the year. So, with this, I come to the end of the presentation. And thank you so much for the patient listening. And more than happy to take questions.
Right, Mihir, I think this is quite insightful. All of us are thoroughly trained about equity markets in India, but your product offerings are definitely unique, and hence this webinar is quite insightful. So, there have been actually a lot of questions I can read on the chat. So, if we see last 10-year returns of, say, NASDAQ, I think last 10-year returns are close to 20%. Last 5-year returns are also close to 20%. 7-year returns are also close to 20% indicatively. Last 3-year returns are, I think, close to 16%, 15-16%. But last 1-year return is around 1%. So the last decade has all been about US markets in terms of very good performance. But that kind of puts this doubt in the minds of India-focused investors who listen to India-focused fund managers, that in the current context of subsequent decade, it doesn't it look, or doesn't it kind of there's a belief that US as a currency could underperform, US markets could underperform, and hence seeing the past performance investing in US now may not make sense. So I think predominantly there have been questions pertaining to this aspect. So I want you to kind of cover this aspect as a house view or your personal view in this regard.
Sure, definitely. So I think that's a very valid question, because as capital market professionals and as market participants, we really are glued to the idea of mean reversion. Because if definitely the US markets have outperformed, then definitely this decade could be an underperformance as well. In fact, interestingly, if one has to actually have a look at the article that I have written for the CFA Institute in December 2022 newsletter, the first decade of the 21st century actually belonged to the emerging markets, and US markets had underperformed because there were actually two crises that unfolded. One was the dot-com bubble, which was already ongoing, and of course, we know the 2008 crisis. So the first point which I really want to make is, just a reiteration that a faster growing GDP does not necessarily mean a better performing market, because in the previous decade, the Indian economy definitely grew faster than the US economy in terms of GDP growth. But in terms of absolute value generated, because the US is sitting on a higher base, so that is where, in dollar terms, there was more output from their side as well. So that is number one. Second is that we believe that in the US markets, there are two reasons primarily which actually drove a major chunk of the returns. One is the entire shale gas revolution, because US really mastered the art of fracking and extracting shale gas from that entire shale rock. This revolution happened somewhere in 2013, 2014, and this was also an event which marked the revival of US manufacturing. And hence, even the returns that I showed since 2015, the returns have been good. So manufacturing has restarted in the US. That is number one. Second is, of course, as you rightly pointed out, the NASDAQ returns, that over the past, let's say 5-7 years, NASDAQ has outperformed because there have been a lot of disruptions and innovations. A lot of automations across businesses mean lower operating costs over a longer period of time, contributing to higher profitability. So what we believe is that if we really summarize all these trends, Industry 4.0 as they call it, which is a data-driven revolution, there is artificial intelligence, robotic of things, a connected world. We believe that the US markets are in a better position to derive benefits of those trends because these businesses are fairly established there. In the current decade, of course, the COVID has served as a grand reset, if we can put it that way. And definitely, whether which markets will outperform, it will get decided only in 2030. The point is that we are not really focusing or we are not advocating that one should invest in the US markets because it is going to outperform the Indian markets. If we really function with that competitive mindset, then some of us could be dissatisfied at the end of 2030. The larger idea, because is that India is a growth story. And In fact, in some of these multi-region exposures also that we take as a part of ETFs, we have India allocations also. So we have that option also. So we are definitely not an ex-India fund house. We always believe that it has to be both the US and Indian investments, or Indian and US investments. Okay, India could be the core allocation, and global markets could be the satellite allocation. The idea being that we really have to target some of these emerging businesses which could provide a higher return than the Indian markets. Broader US equities may underperform the US markets, but if we are really staying invested in the right set of themes, and as I said, that whether the US markets end up outperforming or whether the Indian equities end up outperforming, this will be decided only in 2030, because the markets will function exactly the way they have to function. Ours is to really take advantage of some of these emerging businesses, which, as I mentioned, are not available for investments today in India, but they have the potential of driving the next leg of growth across different countries and across different businesses as well. So I hope that answers the question. Yeah.
Sure. Another thing, which I think should be covered in this particular webinar for the audience is that, all of us understand, coming from investments background, about LRS, and many investors, especially ultra HNI investors, utilize, the limit of $2.5 lakh as an LRS allowed every year, from a
Okay.
respective PAN card. But, why is it in practical terms, because Phillip Capital is dealing with all these clients, what's, I would say, on the minds of these investors, what are the profiles of these investors, and why and how these investors see a value add in doing that, especially now, when there is an introduction of TDS of 20% on the
Yes.
LRS.
Sure. So first, I think I will address the elephant in the room, which is TCS, which gets applicable from 1st of July 2023. So again, 20% TCS definitely is a larger sum, and to that extent, it is, at least from a timing perspective, slightly detrimental to some of our investors also. Because what is essentially happening is that an investor is, let's say, 1,50,000 is the minimum ticket size. So the investor is remitting $1,50,000, but he or she has to arrange for 1,80,000, because he has to, additionally, because it is tax collected at source, it is collected over and above the payment that is made, and that needs to be paid. And because it is a TCS, it really serves as the function of advance tax. So to that extent, that 20% amount is not an outflow to the investor in true sense, because over a period of time it will be recovered as part of income tax refund. But definitely from a cash flow management perspective, it is definitely some bit of a challenge, because the investor has to arrange for more funds today. That's number one. Having said this, some of our HNI investors who are in which ways paying a lot of amount in self-assessment tax, for them it really doesn't move the needle much. In fact, they are able to utilize the TCS amount against their existing tax liability, and during their self-assessment tax, they can actually be burdened lesser to that extent. Now, coming to the next question, that what kind of investors are really looking at the product? So, we've been managing this for the last 15 months. We've been meeting a lot of wealth advisors and investors. We've been traveling to different cities as well. So, there are three particular kinds of investors who are looking at this product. One is the investors who really want a US focused or a global focused portfolio, because they really understand the value of mitigating single country exposure risk. So they are interested in some of these ideas, and they really want a US dollar kind of a portfolio, which will help them mitigate some of the shocks if at all they arise in the Indian markets. I mean, classic case, most recently, if we see the entire Adani and Hindenburg issue, which caused a correction in, or at least some stress in the Indian markets for the short term. So to kind of mitigate some of these shocks, or to kind of to have the larger portfolio absorb some of these short-term shocks, so people do prefer a dollar-based an asset in US dollar, which will help them achieve those stable kind of returns. So that's number one. The second category of investors is that there are people who are looking at sending their children abroad for education, and they would like to start accumulating a lot of dollar assets today. So in this case, what is happening is that because they want to accumulate these assets today, so they want to invest in the long term. So this is the second category of investors. The third category of investors is that a lot of young investors, which we are seeing, like slightly on the younger side. So they are the ones who are actively tracking some of these themes, some of these disruptions, innovations which are happening across the globe, and they are completely convinced about having a portfolio allocation which can give them exposure to some of these ideas, which in an attempt or which they hope they will achieve an upside from by investing in this portfolio. So this is the third category of investors, that people who are actually tracking those themes. I mean, for just to give an example, so one of our clients is actually a doctor, and he is completely in touch with, or he is completely aware of a lot of global healthcare trends, right from medical devices, genomic revolution. So because the client is convinced about, let's say, the future prospects of these things, so there is a specific allocation, and that is how this is the third category of investors. So yeah, I hope this answers your question.
No, absolutely. So subsequent question, which I think would come to investors' mind when they will want to ultimately take a decision of investing in a product like yours, is that what is the regulatory structure of your product? Because investing such a large sum, and that too in overseas market,
Right.
hence how is it regulated? What is the structure around it? Obviously it's a long term investment one is making, and moreover what has happened these days, as you mentioned, a lot of young investors are coming to your product, and in this particular, I would say, segment, and many young investors, in fact, these days are wanting to have control on their investment. Like they want to do, it's like DIY kind of
Yeah.
investors,
Correct.
right?
Correct.
Obviously, Phillip Capital does add a lot of value in terms of advisory, in terms of portfolio management, right?
Yeah.
In terms of ultimately generating alpha. All those points are kind of theoretically understood, but practically, if you could throw some light on one, what is the structure in terms of regulatory background, as well as the value add beyond a DIY kind of an offering.
Sure. So first, coming to the regulatory structure. So as I mentioned to you, that Gift City is regulated by an independent regulator, the IFSC, which stands for International Financial Services Centers Authority. Now, this regulator enjoys its status as a unified regulator, and the powers that this regulator enjoys is that it is completely distinct from SEBI and RBI jurisdiction. So I can talk some bit of this regulator, because as part of our work, we are actually frequently engaging with officers from this regulatory body. The very purpose why this independent regulator was set up was to actually have a separate framework for an offshore jurisdiction, but most importantly to also replicate some of the best practices which have been observed in some of these offshore jurisdictions in other regions like Singapore, Dubai, London, New York. So that is the primary purpose of the regulator, to actually have the right set of frameworks in place, and in true sense make Gift City a completely global ecosystem by fostering the right kind of fund structures and having the right kind of regulations, which will not only assure investor protection but also make the process very, very seamless. Most importantly, this is an Indian regulator. Now, why would I reiterate this point is that today you have the option of directly investing into offshore funds which are domiciled in, let's say, Mauritius or Cayman Islands. Now, they could be regulated entities, but the regulator is someone who's sitting outside India. So there is always that minor risk that just in case there is, let's say, a strain in the diplomatic relations between the countries, for example, then those investments could be at risk. Here you are rest assured that while we are investing into the global markets, but the investment structure, the investment vehicle that is invested or through which you are investing in the global market is residing in India, in Gift City, and offshore jurisdiction. So, to that extent, you can be rest assured that it is a regulated entity. And that is one of the very strong asks which we have, that, whenever we have these ideas about, setting up global products as a firm and also at a group level, we are very, very critical about the regulatory framework. And that is something that is manifested even for the global PMS. Now, second is the value addition which Phillip Capital is providing. So, yes, Kamal, you are absolutely right that today a lot of DIY products are available. A lot of global platforms are available which give investors an opportunity to invest on their own. What we have largely observed is, and particularly this was the case during the pandemic as well, that there was a lot of participation by investors during the pandemic because there was work from home and people relatively had slightly more time. So they had the opportunity to explore a lot of investment products as well. In this process, what was happening is that because the universe of investment products, not only ETFs, but even other products, they could be structured products, some fixed income solutions for that matter. Because the universe is very vast, many a times what happens is that investors really don't know where to begin. And the way some of these products could be advertised to them, so there is a lot of recency kind of a bias where investors may process information which is very, very recent to them and accordingly take decisions. They may end up over trading in their portfolios. They may not have the patience to really have their investment play out over a longer period of time. So frequent trading, frequent churning in the portfolio may actually result in a very, very suboptimal kind of returns over a longer period of time. And most importantly, what happens in this process is that the investor eventually starts losing confidence in the investment process. And that is where Phillip Capital would, really like to guide our investors. We are the helping hand because ultimately our objective is to generate returns, but most importantly, it is to achieve the investment goals of our investors. The value proposition that we provide at Phillip Capital, at Phillip Ventures, or even the India-based businesses of Phillip Capital, for example, our India PMS, is that there is a very strong degree of fund manager connect. Okay, be the India fund manager Nishit Shah or myself. So we regularly engage with our investors. Okay, thoroughly understand their investment objectives, take them through the nuances of the different distinct investment strategies. Most importantly, also give them appropriate knowledge about what this product will not achieve for you. Like we are not a fund house which really believes in achieving supernormal returns over a short period of time. I mean, the entire portfolio, for example, comprised of ETFs. The idea is to really generate stable, steady, and hopefully consistent returns over a longer period of time. So that is the value proposition that we are offering in an attempt for investors to achieve their investment objectives. So yeah.
Sure, Mihir, we come to the last question,
Sure,
of
sure.
our webinar, and that pertains to risks. There is no investments without risks. And when we are
Absolutely.
talking about investing in global markets through products you offer, we understand there are basic equity market risks, liquidity risks. But apart from this, what are the other risks that you want to highlight to investors for them to keep in mind? And obviously, risk is only a matter of understanding. And if one
Sure, sure, sure.
understands risks and then does a well-informed investment, experience is always, superior. So from that point of
Right.
view, I want you to kind of assess what are the risks that investors need to understand before they attempt to invest in your products.
Sure. So, given the distinct nature of regulations between, let's say, SEBI and some of the regulators in the global markets, a lot of operational frameworks for the domestic investors are completely different if they are to invest in a global market. So, many a times, what may happen is, so this may not be particularly a risk per se, but the kind of documentation or the kind of reports that they end up receiving or the way their investments are really made in the global markets, it may seem a bit unconventional for investors, and to that extent there could be a perception of risk. But we would like to tell you that because this is a regulated product, we are again investing in the global market. Our broker sits out of Singapore, so the broker also is regulated by the Monetary Authority of Singapore. So the regulatory frameworks are in place. One risk could be that perhaps adequate knowledge, if the investor really doesn't have an adequate knowledge about some of these global practices, about how global settlements are happening, about how the global custody works, then there could be a perception of risk as to whether the investments are really safe or not. So to that extent, we really encourage our investors to engage frequently with us and have all their queries clarified. That is one risk. Second risk is again the currency translation risk, because we are talking about investing in the US dollar, which historically has really appreciated relative to the Indian rupee at the rate of anywhere between 2 to 2.5% per annum. Okay, historically. Last year itself it appreciated more than 10%. But the dollar itself is an asset class in its own right, and it will have its own cycles of ups and downs. In fact, right now, the current scenario, if we see, the very reason why the dollar appreciated so strongly was because the US Federal Reserve really indulged in the fastest monetary tightening in recent times. I mean, 475 basis points of rate hike in less than 12 months. So that really contributed to the strengthening of the dollar. And because now we are at a stage where the rate hikes could stop, so again, that could put the US dollar at some risk, and to that extent, the Indian rupee returns may be lower. And again, this is a risk that we are really identifying for our investors as well. And hence, the idea is that after accounting for these risks, also the returns which investors generate should be sufficient for investors to achieve their investment objectives. So these are basically the two risks that we would like to highlight. Again, one is the currency risk, which is an actual risk. Second is perhaps a perceived risk, because investors really need a proper knowledge, a proper walkthrough about how global settlements function, about what are the reporting practices, about what are the rules and regulations in different jurisdictions, because here at least three jurisdictions are involved when it comes to us managing the product. So, that is one knowledge which we really need to pass on to the investors, which we, of course, frequently do.
Sure, Mihir, I think this has been summed up quite well. And the product that you have kind of shared is truly unique because there are very few products in this particular category that I have heard of. There are products which are domiciled out of Singapore, out of Mauritius, right? And then obviously those products are different and they have different types of risks. And your product, is definitely attractive in that particular space. And this brings us to the end of this webinar, where I would like to first thank everyone for logging in today. Also would like to highlight that we at PMSAIF World try and find out the best products in the respective category and help investors make well-informed investment decisions. I can see in the chat, some people have asked for more information. I would urge them to go to our platform PMSAIF World and book your appointment with our specialists. We'll be more than happy to help you and more than happy to kind of handhold your investment journey towards your goals of wealth creation. We are quite dexterous in the in the space of alternatives, and that begins with the first conversation that you do with our specialists. Thank you once again for logging in today, and thank you, Mihir, for your time.
Thank you so much, Kamal and team, for organizing the webinar. And thank you so much for the kind of questions that were asked. It really gives me the confidence that the right set of concepts have been conveyed. So thank you once again for your patient listening. Wish you all a very happy weekend. Thank you.
Pleasure.